I think when you look at the retail sector, the haves and have-nots are all about the store concept or how attractive they are to the consumer. The consumer is strong. I mean, there's no question about that. You know, you've got unemployment at a 50-year low, wages are rising. I think that's fine. We're all obsessed with this yield curve, and I get that. It is one of our 6 recession indicators. But let's also all take a breath. None of the other 5 are pointing towards a recession at this point. Claims are low. Inflation is low. Housing starts are still pretty darn good. I mean, they've come off a little bit off their highs. High-yield spreads are still tight. Manufacturing still in expansion territory. So I think we all need to just take a breath on this recession talk. Yeah, there's risks out there, sure. But right now, the U.S. consumer has remained unflappable, and there's really no signs of weakness there.
What's curious to me is there have been various industry groups that have been in focus over the course of the past half-decade with regard to their predictive power over the rest of the market and the rest of the U.S. economy. I think to things like housing. I think to transportation stocks. I think to semiconductors in this whole China trade dispute. So is retail now becoming perhaps that indicator, that forward indicator that we could look to for the next leg higher, if it's to happen in the bull market?
Yeah, I think when you look out at the U.S. economy, you've certainly seen softening on the manufacturing side. Certainly trade-related parts of the economy are reacting to what's going on with China. The consumer is that big, strong bastion of strength. And so if that were to kind of roll over in any kind of way, and you'd probably see it first in the labor market. I think you'd see it there before you would see it necessarily in confidence or spending. If that were to switch, then you have to become more cautious. But at this point, there's really no legitimate sign of that. The consumer remains very solid.
What if the other 5 of your 6 sort of, data points end up pointing towards a recession, but the consumer stays strong?
Yeah, so I think when you look at those 6 recession indicators, the one that you do not mess around with is claims. Because you can go from the cycle low in claims to a recession faster than any of the other ones. Claims go bad, you get out of town. When you think about the other 5, every recession that's occurred since 1969, at least 3 of those have gone bad. So the way we think about it, right now, the yield curve is kind of in yellow territory. It's inverted, but not as inverted as it usually gets before a recession. And the way we would think about it is 1 goes bad, that warrants your attention. 2 start going bad, maybe you're selling highs, you're selling rallies. 3 or more go bad, or if any one of those is claims, it's time to get out of Dodge.
All right, so if that's the case, I mean, the idea here is you have these indicators.
Yep.
With only one flashing this kind of yellowish signal right now, how do you then position? Still aggressively long, and if so, where? And if not, where are you staying away from?
So we were, last December, we were pounding the table to be long equities, and we were on a scale of 0 to 10, we were 8 out of 10 in terms of our equity overweight. We pared that back in the May-June period all the way down to 3. And the reason why is I need more clarity on 2020 earnings in order to really get aggressive and see major upside. Well, what do I need for that? The Fed needs to get on board with a more aggressive rate cut cycle, because otherwise, if the rest of the world's stimulating and we don't, dollars are going to shoot up, and that will hurt the consumer. We need to have some clarity on trade. I don't even care what the clarity is. I just need to know what the earnings numbers are going to be next year. And then I think Hong Kong and Brexit also present 2 really important risks here. So when we get a little bit more clarity on that, then I think you can get more aggressive. But until then, we're content to stay a little closer to the vest.